The fact is that markets fluctuate in a big way. How do we safeguard our money from these fluctuations? What should we be doing? What kind of solutions should we look at? How is it that we need to exit from our mutual funds? What is the best way? So many questions. Answers will be given by Dhirendra Kumar. My name is Rajesh Lake. And to tell you that Investors Hangout is brought to you by Aditya Birla Sun Life Mutual Funds and Value Research. Dhirendra is the CEO of Value Research, and he has a very difficult question coming his way, and that is, how should we withdraw from mutual funds?
Yes, what we saw was, markets went down a little bit, or, went down for a couple of days, and investors just run for cover. They think that,
Yeah.
they wish they could have, uh, been able to, they should they sell? They are faced with this question. They see the investment value going down. And big market movements, that should not be a driver of your for your need to sell, because many people get scared when you see your investments going down in value by 5%, 2%, or
Correct.
1% every day. But that definitely should not be the case, because that is exactly why you invested in the first place, to optimize your return or maximize your return. Market fluctuation is very much an integral part of it. Markets will fluctuate.
Fluctuate.
The key thing to ask is that there are reasons why you should sell your fund. The primary reason is when you need the money. The
Fluctuation, no fluctuation.
fluctuations or no fluctuation. Or if you are reorganizing your portfolio, your needs have changed, your needs were different, and now it has changed. So you need to really sell your fund and buy some other kind of fund which is more appropriate for your current conditions. I think the third reason to sell is when your funds are doing poorly. You have a fund, and when you bought it, you thought that you did the diligence, you saw the ratings, you looked at the performance, you looked at how consistent it is doing well, and after you bought it, after a couple of years, you find that it is no longer having those variables. It is not doing well as it used to. So when you should sell your investment? That is the question. And I think these are the reasons why you should sell a fund. Markets going up or down, markets are like that only. Markets will either go up very dramatically or will go down very dramatically. And if you are trying to time it perfectly, if you want to avoid this decline, and if you want to only ride the gains, it is not possible. You will not be able to realize and the benefits of investing in equity.
So what I hear is that market fluctuations should not be the reason for you to sell. Your need is the reason why you should be selling.
Yes.
All right, moving on. Is there any method in which you should be redeeming from your or profits? Mutual funds make profit. Now, is there a methodology involved in that?
There is a method, but for that method you have to really pre-state what you have set out to do.
Okay.
Because if you don't set out a goal for yourself, depending on your goal, many people don't have a goal. It is just a long-term investment for your retirement, and you are still in your income years. You don't depend on your investment, so it doesn't matter. Then you carry on. But if you are investing for a specific goal with a defined time frame or a defined amount of money that is needed, then you should sell. You set out to actually put together your down payment for a house, and you thought that you'll be able to do it in 3 years, and it has happened in 2 years time. You by all means take your money out and go ahead, and because there is no greater success than actually achieving a goal. That's one. You reach a goal, take your money out. Don't get greedy at that point, that if the money is going up anyway every day. Then the other, there are other things, there are other situations. I listed 3 reasons. When your needs change, or when the fund actually stops performing. That is something where you should have objectivity. The reason why you choose a fund is, it has, we talked about 2 weeks back that how to go about choosing a fund. It is doing consistently well, it has a superior rating, and when you look at those 2-3 variables when to choose a fund, when they slip for a prolonged period of time, what is that prolonged period of time? Should you really take note of just market going down? May not be a good yardstick to evaluate a fund on. Because if market goes down by 5% in a month's time, and if your fund has gone down by only 2%, your fund has done exceptionally well. And the reverse situation. You have to see that what time frame you will take. I would say that don't get out of a fund in a hurry just because the market is going down. Yes, on a relative basis, if it is doing poorly consistently, for a relatively new fund, I will give it a 1 to 1.5 year time frame. If it has done very well in the past, and off late it has started doing poorly, but not a very old fund, 5 6 year old fund. If it's a 20-year-old fund, it has an impeccable history, a great track record. 18 out of 20 years it has done exceptionally well. 1 or 2 year of bad performance, I will still not exit. I'll be inclined. Of course, you have to see that the fund manager is still there. There are red flags. You have to see a couple of things when things become, when you should be worried. But beyond that, I think one should not be getting in and out of a fund. Many investors, there are other situations. Many people have too many funds. They are not an investor. They just become a collector. And too much of diversification may not be in your best interest. Your investments might become almost like an index fund. Your underlying investments could be so widely spread that it is a very wrong form of diversification. So maybe getting rid of some funds to consolidate your portfolio, to have the manageability, to be interested, and to be able to keep track of it well, might be, that is another reason when we should sell some and then go about choosing, consolidating all your money in fewer well-performing funds.
You mentioned one of the reasons to look out for is the performance of the fund and the rating it has got.
Yes.
What are the measures? I mean, what are the, okay, let me not say measures, let me say how are funds rated? And then how should we know that, okay, it has come from 5, say 2 or 3?
Yeah.
If it has come down, what could be the reasons for it coming down?
Yes. The primary driver of our rating system is one, that it is completely quantitative. It is based on numbers. There is no qualitative input. We are not sitting there and actually thinking that this fund has stopped doing well. It is not a subjective opinion. It is entirely based on numbers. The numbers are, the formula that we devised in 1993. We have been rating mutual funds since 1993.
Still holds good?
It has undergone a great deal of refinement over a period of time, because then there used to be only closed-end funds, and then the emergence of open-end fund, then the classification system, which is the bedrock, which is the basic foundation. Because the whole premise of mutual fund rating is that we are comparing relatively superior, consistent performance of a certain kind of fund. So, first and foremost, you cannot compare a 5-star equity fund with a 5-star balanced fund. A 5-star balanced fund means among the balanced fund, this has delivered the best risk-adjusted performance. That does not mean only performance, because when you look at returns, you are only looking at performance. This means how volatile it has been, and how volatile it has been compared to other funds of similar kind. So it is just a yardstick to measure how consistent it has been. So performance is also factored in that. So I would say that one should, the starting point of the rating system is that it is a good filtering mechanism. If you go about choosing a fund, start from a universe of 5-star and 4-star fund, which means eliminating the 3-star, 2-star and 1-star is a good way of looking at it. It narrows your universe. It makes your life easier. And funds to avoid, I think that's the first service it delivers. Then comes whether it should be used for a tracking or monitoring. Yes. If a 5-star fund remains a 5-star fund, I don't think there is much to worry. Or a 4-star fund remains slips from 5 to 4, I really won't bother much. Slips from 3-star to 2-star, I'll worry, and I will definitely ask more questions. And I'll be reasonably, and if it stays there for 6 months, I'll be inclined to sell sometimes.
You mentioned about if the fund has done very well for, say, 10 years, 15 years, and if it is not doing well for the past 1 or 2 years, how much time should we give to that fund before withdrawing from it?
15-year, 20-year-old fund, I will be willing to give it, 2 years in 2-star and 2-star rating grade. But if it's a 5-year-old fund, was a 5-star fund, and then slips gradually to become a 2-star fund, then I think I will not wait for, and if the fund manager has also moved, then so I will be looking at fund manager changes and how old it has been, because there is a possibility that when you are looking at a 5-year 6-year cycle, the fund would have just hit upon some great I'll be primarily looking for the design of whether some design has translated into performance or whether it is an accident. And that accident can in market, it can actually, an accident can actually boost your performance for 2-3 years, and there may not be a great design behind it. It may not be the fund manager's brilliance sometimes, so he just might be lucky, or he just hit upon something, and that has exaggerated or a substantial impact on performance, and it lingers over time, and it actually gets factored in all your performance calculation all the time. So I will be worried about if a fund slips from 3-star to 2-star and stays there for 6 months, 1 year. I'll be inclined to and I'll definitely use it as an opportunity to delve deeper.
Okay. And in our last program, we talked about how we should be withdrawing our money from mutual funds, so that the ways of doing that remains the same. Quickly, in one line, if you can tell people how to withdraw.
The systematic withdrawal plan for your income needs. I think that's the finest thing that can happen. Mutual funds become a great vehicle for somebody to convert your regular cash flow into a pool of capital, or a pool of capital translating into a cash flow for you, and that is how it should be used. If you invest a large sum of money and want to derive an income from it, the market decline should not bother. Yes, but you should be concerned about the amount of money that you are withdrawing. If you take out a lot of money, you will actually impair your capital. You must you must withdraw conservatively based on your needs. I think 4 to 5% is a conservative estimate, which should be the annual withdrawal rate, and you should revise it depending on. And if you do it like this for 2-3 years, your capital grows, and if your capital grows, then you'll be able to withdraw on the higher percentage, assuming that you have 5 lakh rupees and you take out 2.5 lakh 50 lakh rupees, of which you want to take out 2.5 lakh rupees a year, which is about 5%. So if the remaining 47.5 lakh rupees will appreciate more, next year you can revise the 5% of the revised amount, the 47.5 lakh which is appreciated, whatever is left over, the higher the amount. So by devising this kind of a conservative withdrawal mechanism in initial years will ensure that you are able to grow your money faster. You have enough capital, and this is one of the simplest way whereby from a pool of capital you will be able to ensure inflation adjusted income for yourself.
Correct. So we're talking about how to withdraw from your mutual funds, and one of the questions that I have now for Dhirendra is that what if I have multiple funds? What should I do? Which one should I offload first?
Same yardstick.
Which you touched upon a while
consistent back. Performance. So if you have many funds, choose the best of the lot. There are two things, when you are doing this exercise, you should be careful about two things. One is the exit load. Most equity funds and balanced funds levy an exit load if you redeem your investment before 1 year.
Correct.
So make sure that if you have been doing your SIPs, or if you have made a lump sum investments, or if some of your SIPs have been discontinued but your money is not old enough, make sure that they become 1 year older. So that there is no exit load. Otherwise, it generally varies from 1 to 1.5% or 2% if you take your money out before 1 year. It is also tax inefficient. All the gains that you would have generated on those investments which you redeem before 1 year, 15% short-term capital gains. So 15% of your gains will go up on account of taxes. So these are two things which one investor should plan and actually try and avoid it.
In case of debt funds, as you just mentioned, which one should I exit first? 3 years, or the ones which have just one is 1 year old?
Debt fund is a different thing. Debt fund is one about debt fund. The selection of debt fund, the most important thing is the time frame. Your investment time frame must match with the appropriate category. If you are investing for a few months or few days, then the right kind of fund, and I don't think you need to really sell it. It is generally a need driven investment. Then comes, if you want to really make it efficient in terms of withdrawal, then you have to hold it for 3 years. Otherwise, there is absolutely no advantage of investing in a debt fund on tax efficiency.
Correct.
And tax efficiency actually is a big edge for investors, because you are able to convert your taxable interest income by holding it in the form of a mutual fund. It actually becomes a capital gains and far more tax efficient.
And for that 3 years is important.
For that 3 years is mandatory.
Okay. So how to withdraw from mutual funds is what we discussed, and if you have any query, then you write into us as the way you've been doing previously, and we would be taking your questions at this point in time. And we want to reiterate that Investor Hangout is brought to you by Aditya Birla Sun Life Mutual Funds and Value Research.